welcome back to the episode 7 of how to trade market maker models. In this video I will talk about market maker models, the entry protocol, the different stages of a market maker models. So for the summary of the video, I'm going to first show you how a market maker model is formed. I will then talk about the different stages, then the entry protocol, and at the end I'm going to show you some live examples on the market. So if you remember the video on internal range liquidity and external range liquidity, I told you that price moves from external to internal and from internal to external. So you will basically see in this video that every single thing I teach you is going to blend together in this video. So let's start with the market maker buy model. So in a market maker buy model, okay, you're gonna have a curve here. So first a sell side of the curve and then a buy side of the curve, okay. So after price created external range liquidity here, so this is called the original consolidation, price will drop into the high time frame PDRA, so the internal range liquidity, and then start the buy side of the curve. Okay, so a market maker model has three different stages. So first the low risk buy or sell, depending if you are in a market maker buy model or sell model, the first stage and the second stage. Okay, so after price reached the internal range liquidity, you will see a shift in market structure. So price will shift from bearish to bullish. Price will create the low risk buy. Okay, so when this happens on the chart, you basically do nothing. Why? Because the low risk buy is the first kind of entry you have on the market maker model, and it's low probability because it's the first entry, so you do nothing. Price will then continue higher, create a weak low, run this weak low to create the first stage. So that's why I wrote turtle soup here. Okay, so this is your high resistance signature. Price will then displace up and create the second stage to then go towards the external range liquidity. So external, internal, and then external range liquidity. The first type of market maker buy model, so I will say 80 to 90% of the time, you are going to see that the turtle soup will happen on the first stage. Okay, so the high resistance signature will happen on the first stage, but 10% of the time, I would say, you will see something like this happening. Okay, so the high resistance signature or the turtle soup will happen on the low risk buy. If the turtle soup happens on the low risk buy, the first stage and the second stage are going to be continuation, meaning that you are not going to see something like this happening. Okay, so low risk buy turtle soup, first stage turtle soup, and then second stage. Okay, so this will most likely not happen. Okay, and you will only have a turtle soup or a high resistance signature on the low risk buy, not the low risk buy and the first stage. Now for a market maker sell model, it's exactly the same thing as before, but the other way around. So you have your curve here, buy side of the curve, sell side of the curve. You have your external range liquidity here with your original consolidation or smooth edges. Price will then go up into the high time frame PD array, so the internal range liquidity, and you have external, internal, external again. price will shift structure to bearish, create the lowest sell, okay, displace lower, create the first stage with the turtle soup, then displace lower again, second stage, and go towards the external range liquidity or the target. So that's again 70-80% of the time, and 10% of the time you're gonna have something like this with the low risk sell with the turtle soup, and then the two next stages are going to be continuation, meaning no turtle soup again on first stage. Now, for the entry protocol, you're going to say to me like, yeah, okay, thank you for the explanation on the different stages and everything, but why did you draw a premium discount on the right hand side of each explanation? Listen carefully, because this is like the most important part of the video for the entry. So what I'm gonna do is just give you a little time to kind of see where each stages are on the premium and discount. You see, so this is the equilibrium. You have lowest buy, first stage, second stage. And I'm gonna show you again every type of market maker model that is possible, and just try and see if there's something that you can spot for the second stage, okay? So this is the classic market maker buy model. This is the market maker buy model with the turtle soup or high resistance signature on the low risk buy. This is the market maker sell model with the low risk sell, first stage and second stage. So classic one with the turtle soup on first stage. There you have your equilibrium. And this is your market maker sell model with the turtle soup on the low risk sell. So as soon as price for a market maker buy model, as soon as price shifted again from bearish to bullish, what you're gonna do is anchor your Fibonacci from the lowest point of the buy side of the curve here. So this is called this money reversal. So from here to the external range liquidity, okay? So you can see here, the lowest point here to the external range. Now, the equilibrium here, you can see that the lowest buy and the first stage are below the equilibrium, so in discount, right? What's going to happen on the market is that you're going to see first stage being created, and then price will displace higher aggressively around the equilibrium, okay? Price will then leave a fair value gap or any type of PD area behind, and the second stage is going to be above the equilibrium, okay? So in premium. And that's really, really, really important. So listen carefully. You always want to enter when you see huge displacement higher around the equilibrium, and second stage is going to be above the equilibrium, okay? So that's basically the same thing for a market maker sell model. You're gonna anchor your Fibonacci, okay, so your premium discount on the smart money reversal to the external, and you can see that second stage is below, on a market maker sell model, below equilibrium, okay? Huge displacement here, second stage below equilibrium. This is going to save you a lot of time, because what's gonna probably happen, okay, a lot, is that you will see that price will create the lowest sell, the first stage, and then price will have some difficulty to displace below the equilibrium, and you will see some wicks being created, and then price will just reverse higher. But if you wait for a big displacement lower around the equilibrium, this is going to save you and give you the highest probability entry possible. Moving on to the first example of a market maker buy model. So you see we have a range here from range high to range low, okay, with a weekly fair value gap here. Price went down in discount. So we have internal, external range liquidity, and this is a weekly fair value gap. So we drop down to the 4-hour time frame if you saw the video on time frame alignment. So here we are on the 4-hour chart. We can see that price ran this low, okay, created a high probability order block here. So when price closes above this order block, we shift structure to bullish, so bearish, sell side of the curve, then buy side of the curve, we are bullish, okay. So now what are we doing? We are anchoring our Fibonacci from external to the lowest point here, so the smart money reversal. And look, this is the second type of market maker buy model, where we have the turtle soup at the low risk buy here. So here we have the low risk buy, then a little fair value gap created here, okay, and we can see that price can't really close below the fair value gap, so that means that price wants to go higher. That's a signature in price, okay. So we have our low risk buy, then we have here our first stage, okay, and if the total soup happens on the low risk buy, then the first stage and the second stage are going to be continuation. And now I'm going to do something a little more. If you are a beginner, I would suggest not doing this, but if you're a little more advanced, I'm going to drop down to the 1-hour time frame just to draw this 1-hour fair value gap, because it's going to help us with risk reward, okay. So there we have our 1-hour fair value gap. So lowest buy, first stage, and then second stage, and you can see that we have huge displacement here around equilibrium. So that's a sign that we can enter here. Okay, so on the second stage, stop loss below, okay, so at the low on the first stage, and target the buy side liquidity, okay. So you can see that every criteria was met, and that price went down, created second stage, and then displaced higher towards the external range liquidity. Now for the second example, we are on GBP AUD. Okay, so price went down into a weekly fair value gap. Okay, so we have external resting above, weekly fair value gap, 4-hour market maker buy model. Okay, so price ran this low here. First thing we do is look for a shift in market structure. Price closed above this inverse fair value gap here. Okay, so that's a sign that we are now bullish. So what we do next is anchor our fib, so our premium discount here. And we can see, you can see your original consolidation here, smooth edges, okay. And we can see that price ran this low, so that's a low risk buy with turtle soup, meaning that the next two stages are going to be continuation. Price created a fair value gap here, no close below the fair value gap. That's another way of saying that price wants to go higher. And then we have our an order block here, okay, so we can enter right there, stops here, and target this equal high or external range liquidity. Okay, so from external to internal and from internal to external. I'm going to show you the displacement that we had around the equilibrium if we drop down to the 1 hour time frame. Okay, so you can see here, price created the first stage, then displaced higher around the equilibrium here, and gave us our entry right there. And you can see that after second stage, price will most of the time just run into the external. You will not see like price consolidating or anything. It will just be a clean move and fast move towards the external range liquidity. For the last example, so this is going to be a little different because it's going to be a market maker sell model but without any high resistance signature. So this can happen also in a market maker model. So we have a 4-hour fair value gap. Okay, so internal, external below, price will move from external to internal, so inside the fair value gap, to external, okay, towards this sell side liquidity here. So 4-hour fair value gap, we are dropping to a 15-minute time frame, and we can see our original consolidation here. Okay, so smooth edges, you see these low right there, so that's our original consolidation here. I'm going to move this a bit to the left, right there. Okay, so we have our smart money reversal here. Price then close below this low here. Okay, so we are shifting structure to bearish. Next thing we do is anchor our fib from the smart money reversal to the external range liquidity, and we can see here, okay, first stage, sorry, lowish sell here, no breaker, fair value gap here, then a return into this. So this is a propulsion block actually, but I'm going to mark out this fair value gap. Okay, so you see here no high resistance signature, neither on the lowish sell or the first stage. And then what can we see after the first stage? Big displacement around the equilibrium, a VG behind, and that is our entry towards the throw on liquidity, so the sell side here. So that's where we enter, right there. And you can see then no consolidation, no nothing, just a clean move down towards the external range liquidity. So that's it for today's video. If you learned something new, make sure to leave a like, subscribe to the channel, and write a comment down below, and I will see you for the next episode.